Today, we're diving deep into the world of private equity. We're talking about a multi-trillion-dollar industry, a powerful, often invisible engine that can take a simple idea and turn it into a global force. But, as we're about to find out, this engine comes with a pretty big catch.
I mean, have you ever really thought about it? How does a brilliant concept, maybe something scribbled on a napkin, become a company that literally changes the way we all live? Well, the answer, more often than not, comes down to one crucial ingredient: financing. And that's exactly what we're going to unpack today. What are we really talking about when we say private equity? Let's get a nice, clear definition on the table. At its core, it's actually pretty straightforward. Private equity is just when investors buy ownership or equity in companies that aren't traded on public stock markets. Think of all the companies that aren't on the NASDAQ or the New York Stock Exchange. For them, this kind of capital can be an absolute lifeline. And it's not just for those flashy tech startups you hear about. Nope, private equity money helps established, mature companies get to the next level. It keeps stable businesses strong, and it can even be the thing that saves a struggling company and turns it around. It's an incredibly flexible financial tool. And the sheer scale of this industry, it's just staggering. Back in 2019, private equity funds were managing over $4 trillion in assets around the world. That is a massive amount of money being pumped into the real economy, shaping whole industries, and for better or worse, driving growth. Now here's where it gets really interesting. Look at this chart. Over 90% of all that capital is concentrated in just a few places: the USA, Europe, and Asia. This just goes to show how vital private equity is to developed economies. But you know what else it shows? A huge, huge opportunity for other regions to build their own engines for growth. Okay, so we know what it is. But, and this is a big but, not all private equity is the same. It generally splits into two very different paths, and they have completely different goals. So on one side, you've got venture capital. This is the high-risk, high-reward stuff. It's about betting on those tiny, early-stage startups, the ones with a wild idea that could either change the world or totally flame out. Then, on the other side, you have growth and buyout capital. This is for the big guys, the established companies. The goal here isn't about inventing something brand new. It's about making what's already there bigger, better, or more efficient. And that difference brings us right to the central conflict of our story. It's a dilemma that pits short-term profits against true long-term innovation. It's really a clash between two philosophies: extracting value quickly versus creating value sustainably. Now, to really get this dilemma, we need to understand this key concept: generative growth. This isn't just about a company getting bigger or squeezing more profit out of its existing product. It's about a company's ability to constantly reinvent itself, to come up with radical new ideas that keep it essential for decades to come. Let's look at a hero of this story, the French company Tefal. This is generative growth in action. They started way back in 1954 with just a single patent for non-stick pans. But they didn't stop there, right? They moved into plastics, then electronics, expanding into all sorts of cookware and home appliances. That is what long-term value creation looks like, and it's why they've been successful for so long. But now, let's look at the other side of the coin, the cautionary tale of SoLocal. This is a textbook example of short-term value extraction. SoLocal was a super successful phone directory company. In 2006, it gets bought by private equity funds. But instead of investing in its future for the digital age, they loaded the company with debt just so they could pay themselves quick dividends. That debt ended up eating 60% of the company's revenue, starving it of the cash it needed to innovate. The result? A predictable decline. So you have to ask yourself, why does this happen? Well, this timeline explains it perfectly. A typical private equity fund operates on a strict clock, usually about 10 years. They have to buy companies, fix them up, and sell them all within that window to make a return for their investors. This means they often only own a company for 3 to 5 years. That incredibly short timeline creates immense pressure for quick wins, and that often comes at the expense of those amazing long-term growth projects that might take a decade to really pay off. So that's the dilemma. It's a big one. But the story doesn't end there. Faced with this exact problem, innovators in finance are starting to forge new solutions, building something you could call a more patient kind of capitalism. A really powerful example is coming from government-led groups. Take Bpifrance, which is a state-owned investment bank in France. It has committed billions of euros to provide what they call patient capital. This is investment that isn't tied to that short 10-year clock, and it's designed specifically to let French companies focus on real long-term innovation. Forward-thinking investors are also changing how they play the game. You see, the old way of valuing a company was just to look at its current products.
but the new, smarter way. It's about assessing its potential for future innovation. Does it have a killer R&D team? Does it have great research partnerships? Is there a pipeline of new ideas? That's where the real long-term value is.
And this shift in thinking has led to totally new financial tools. So let me introduce you to permanent capital funds. Just like the name says, these are investment funds with no expiration date. They can hold a company for as long as it makes sense, giving that business the stability it needs to chase that true generative growth without constantly worrying about being sold.
And maybe the ultimate form of this patient, smart investing is when you don't just invest in a company, you build an entire ecosystem. Just look at Intel in the 90s. They built a chip that was so powerful, no computer on the market actually needed it yet. So what did they do? They invested in other companies to create software and devices that would need all that power. They even designed the USB standard just to connect everything together. They didn't just sell a product, they literally built the market for it. Now that is next level value creation.
So when you look at all these different examples, they're all pointing towards a new future for how we finance innovation. And that brings us to the big final takeaway. The really crucial point here is this. Getting a startup funded and off the ground, that's only half the battle. The real long-term challenge for any economy is making sure that once those startups become successful, mature companies, they have the right kind of financing to keep innovating, to keep pursuing that generative growth, just like Tefal did. And that means it's not just up to individual investors. As this idea suggests, nations themselves have a massive role to play here. By setting smart policies, by supporting national development banks, and by shaping the rules of the game, governments can help build a private equity industry that supports companies not just for a few years, but for their entire life. And that leaves us with this final critical question. How do we build that system? A financial system that values patience as much as it values speed, that rewards long-term vision, and that ensures the great companies of today can continue to be the great innovators of tomorrow. Solving that puzzle, that's absolutely key to our future prosperity.